So, when considering how equity release works, what I'm talking about here is a lifetime mortgage. There is another sort of equity release called a home reversion plan, but I'll deal with that in another video. An equity release in terms of a lifetime mortgage is a mortgage secured against your house. There is almost always a fixed rate for the rest of your life. The money that's released is tax-free. Now, you can choose to take the money in one of two ways. One is as a simple, straightforward lump sum, and that's determined by the value of your house and the age of the younger borrower. Okay, so the other way to take money is with a drawdown facility. Now, with most lenders, the minimum initial loan is £10,000, but the rest of the drawdown facility can either be a set amount, if you have a really clear idea of what you might need in the future, or it can be a larger amount that you can just draw on as and when you need it. The bigger the drawdown facility, generally speaking, the higher the interest rate you will pay for it. The benefit of the drawdown side of things is that you only pay interest on the money you have actually taken. The rest is sitting there like a credit facility. There are a couple of terms and conditions around that your advisor will talk you through. But the beauty of it is that you don't pay interest on the money in the drawdown facility until you use it. Now, being a mortgage, the lender has a charge on your property, which means that when you sell the property, or when the property is sold after your death, or if you need to go into long-term care, then that charge needs to be repaid. So the lender will get their money back plus any interest that hasn't been paid in the meantime. Your family can choose to pay it off themselves, or the house can be sold. Once the lender has been paid back, any residual value from the sale of the property will go to your estate, and it'll be divided however you've done your will. If you go into care, then the house may need to be sold, and really, when you're thinking about equity release in this side of things, it's really important for you to have power of attorney set up with family or someone that you trust to make decisions on your behalf, in case you're not able to make those decisions for yourself. So if you're taken into care and the house needs to be sold, then the mortgage will get repaid, and the remaining balance will be available for use to pay for your care or whatever else you may need at that time.